Before we begin, this video is for educational purposes only and is not financial advice. Always do your own research and consider speaking with a qualified financial advisor before making any investment decisions. Now, picture this. You open your energy bill and it's noticeably higher than 6 months ago. You check the news and oil prices are up 50% since the conflict in the Middle East escalated. And now you're wondering, should I be buying energy stocks to profit from this? Or is this finally the moment that renewables take off? That's exactly what we're unpacking today on the European Investor. Oil is up 50%. That's a structural shock. The conflict involving Iran has disrupted regional supply chains and sent a clear signal that geopolitical risk is back on the table. For European investors who already lived through the energy crisis of 2022, this feels uncomfortably familiar. Oil prices don't just affect petrol stations. When oil rises sharply, transport and manufacturing costs go up, and those costs flow through to everyday goods. This is especially painful for Europe, which imports a significant share of its energy and is particularly exposed when global supply tightens. When an oil shock hits, two types of investments tend to attract attention. The first is traditional oil and gas companies, the so-called oil majors, who directly benefit when the commodity they sell becomes more expensive. The second is renewable energy companies, whose long-term investment case often strengthens when fossil fuel prices spike and governments accelerate the clean energy transition. Both paths come with very different risk and return profiles, and that's what we're going to dig into. Here's the simple logic for oil majors. When oil prices rise, their revenue goes up almost immediately because they're selling the same barrels at a much higher price. Much of their cost base is fixed, so margins expand and free cash flow surges, often flowing through to higher dividends and buybacks. But that operating leverage cuts both ways. It works in reverse when prices fall. Several large integrated oil companies have paid and grown dividends for decades, and many add share buybacks on top during high oil price environments. For income-focused investors, that combination of yield and capital return can be appealing, though it's never guaranteed to continue. But oil prices don't stay elevated forever. Commodity cycles are real, and what goes up can come down sharply. Beyond that, oil majors face a longer-term question. If the world gradually moves away from fossil fuels, what happens to the value of the reserves and infrastructure they hold? These stranded asset risks aren't immediate, but they matter for any long-horizon investor. Now let's turn to renewables. The long-term case rests on two reinforcing forces. First, decarbonization. The global push to cut emissions means fossil fuels need to be replaced over time. Second, energy security. Europe's painful dependence on Russian energy in 2022 and now renewed instability from the Middle East has convinced policymakers that homegrown clean energy is a strategic necessity, not just an environmental choice. The Iran conflict is reminding European governments why they need to move faster on domestic energy production. Every solar panel and wind turbine installed in Europe is energy that doesn't need importing from a politically unstable region, and that argument tends to translate into stronger policy support and faster permitting for renewables. Europe's policy landscape has been strongly supportive of renewables for years. The European Green Deal and the REPowerEU plan, launched after the 2022 energy crisis, set ambitious targets for solar, wind and other clean technologies, giving renewable companies a degree of revenue visibility that can make their cash flows more predictable than you'd expect. Here's something that often surprises people. Solar and wind have become dramatically cheaper over the past decade. So much so that in many parts of Europe, new renewable capacity is now the cheapest form of electricity generation available. That's good economics, not just good environmentalism, and it makes the investment case less dependent on subsidies than it used to be. Renewables are not without risk. Many companies are capital intensive and borrow heavily to build projects, which makes them sensitive to interest rates. When rates are high, financing costs rise and valuations can come under pressure. They also face permitting delays, grid bottlenecks, and equipment supply chain costs. And after periods of strong enthusiasm, valuations in parts of the sector can look stretched. Let's put the two side by side. In the short term, oil majors have the clearer tailwind. Earnings move almost directly with the oil price. Renewables benefit more indirectly through policy urgency. Over the long term, the picture flips. Renewables' structural story strengthens as the transition deepens, while oil majors face growing uncertainty about their long-term asset values. Both carry significant volatility just from different sources. Here's a question worth sitting with. Does your portfolio actually have to choose? Many investors hold both, not out of indecision, but because the two positions serve different purposes. Oil majors can hedge high energy prices and provide income, while renewables offer long-term growth tied to a structural megatrend. The right balance depends on your time horizon, income needs, and risk tolerance. It also reflects reality. The transition away from fossil fuels is a decades-long process, not a switch. Oil, gas, and renewables will all be needed simultaneously for years to come. If your time horizon is 1 to 3 years and you're looking to benefit from the current oil price shock, the oil major story is more direct. But if your time horizon is 10 years or more, the renewable energy story arguably has stronger structural foundations, because the forces of decarbonization and energy security aren't going away. Neither conclusion is obviously wrong. It depends entirely on what you're trying to achieve. As European investors, we have particular skin in this game. Europe is a large net energy importer, so high oil prices hit European consumers and businesses harder than many other regions. Investing in energy, conventional or renewable, is partly a way of gaining exposure to the sector costing you money elsewhere. It doesn't eliminate the pain, but it can offset it. For most European retail investors, individual stock picking in these sectors introduces concentration risk that's hard to manage. UCITS-compliant ETFs offer broad exposure to either the global energy sector or the clean energy sector with built-in diversification. But watch how concentrated the index itself is. Some clean energy and energy ETFs put a significant share of assets in just a handful of companies. Check the expense ratio, the index it tracks, and its top holdings before investing. History teaches us that commodity price shocks tend to be self-correcting. High oil prices incentivize more production and reduce demand as consumers adapt, eventually bringing prices back down. And by the time a conflict is front-page news, a significant part of the price move may already have happened. That doesn't mean there's no opportunity left, but timing matters, and chasing momentum at the peak of a spike carries real risk of a correction. Here's the honest, balanced takeaway. Neither oil majors nor renewables is obviously the right answer to the current energy shock. Oil majors offer a direct short-term benefit from elevated prices plus dividend income. Renewables offer a stronger long-term structural story, supported by policy and clean energy economics. Both carry significant volatility, and any allocation decision should reflect your own financial situation and time horizon, not just the headlines. If you're monitoring this space, here are the key variables. Brent crude directly drives oil major earnings. EU energy policy shapes the renewable investment environment. ECB interest rate direction matters for renewable project finance. And the geopolitical situation itself can shift rapidly and change the picture. That's a wrap on today's episode. If you found this useful, please hit like and subscribe. It genuinely helps this channel reach more European investors who are trying to make sense of markets like this one. We've linked to a free newsletter in the description below where we go deeper on topics like this each week. And remember, everything on this channel is education, not financial advice. Do your own research, know your own situation, and make decisions that are right for you. Until next time, I'm the European Investor. See you in the next episode.